Welcome to ETF Edge, your go-to place for all things exchange-traded funds. I'm your host, Dominic Chu. While equities are swinging wildly from short-term headlines, one of our next guests says that bonds are seeing long-term opportunities that have not presented themselves for roughly a decade. So joining me now is Jerome Schneider, the head of short-term portfolio management over at PIMCO, alongside Matt Bartolini, the global head of research strategists over at State Street Investment Management. Gentlemen, thank you both for being here right now. Let's start, Jerome, with you, because it's an interesting time for bond investors right now. We've seen the 10-year note yield pretty much locked in a pretty tight range for the better part of 3 or 4 months now, yet all of the geopolitical headlines as of late has caused a little bit of a breakout. What do you make of what's happening in the bond market right now, vis-a-vis things like Greenland, vis-a-vis things like what's happening in Venezuela, and all of the other geopolitical catalysts that are at play?
Yeah, it's great to be with you, Dom. And I think it's important for investors to contextualize some of the headlines we're receiving versus the opportunities that we're observing. This opportunity set is interesting because, one, we have to remember that growth remains relatively resilient. In fact, surprisingly resilient from where we expected it to be only a year ago. And in that context, at PIMCO, we're believing growth probably ends 2026 at about 2.5%. It's one of those things that even though we're facing what we would call a K-shaped economy, where there's people who are doing better than other people, the reality is that the economy is still chugging along at a pretty healthy pace, spurred on productivity, spurred on by capital expenditures within the technology sectors and beyond, and also spurred on by fiscal impulses, which are going to be stimulated by some of the rebates given from the big, beautiful bill from last year. Put that all together, and it creates a pretty fertile environment for differentiation within fixed income. So when you accompany it with a starting point of where equities are, equity valuations, and even some spread products, we're at a pretty high conviction level, meaning relatively high risk with relatively low expected returns for many of those sectors for equities and beyond. And so from that perspective, where we look out at the fixed income landscape, not just in the US, but globally, opportunities present themselves not only in nominal returns, but also real inflation adjusted returns, which could put investors in a compelling place where they could earn equity like returns with a fixed income allocation over the next several years. It's a pretty interesting dynamic to have, and something that we've often looked for at PIMCO over the past decade, but are only now seeing it come to fruition with such clarity.
You know, Jerome, you've piqued my interest here, maybe that of our viewers and listeners as well. Where exactly are those opportunities then that you're looking at from a portfolio manager's perspective? What stands out to you right now?
Yeah, we're clearly in a late cycle corporate credit environment, which transcends itself to the risks, some of the risks we're seeing in the equity markets. But at the same time, when we think about the opportunity set, it's more global in nature. You have monetary policies that are very divergent for the first time in almost a financial generation, that you have rate cutting that might be more beneficial to some certain jurisdictions like Australia and England versus the United States. And obviously, there's different dynamics going on in Japan. Those are important lessons for people to really adhere to when we think about opportunities in fixed income. It creates differentiation, relative value opportunities that creates excess returns in that fixed income landscape. At the same time, when we just sort of look where we are in the yield space, yes, there's a lot of fear out there, perhaps related to trade policies, geopolitical tensions, but we're in that range that you alluded to. The 10-year note trading at 4.28% right now is still in that range of 3.75 to 4.5% that PIMCO's been talking about for a very long time. So from that perspective, that is the opportunity, the baseline to generate income, plus some opportunity for additional returns that allows you to have a total return that's probably in the 6 to 8% for most fixed income type of strategies that are diversified. And that's the compelling opportunity to have an equity-like return in fixed income at this point in time.
Equity-like returns. I mean, Matt, this is an environment right now where there have been some analysts and strategists who believe that the market is either very fairly or even overvalued at this point. Yet there are still opportunities out there right now amidst some of the near-term volatility in those equity markets. What exactly are you seeing from the State Street side of things as to where some investors are kind of moving some of that money around? What types of opportunities are presenting themselves on that equity side of the business?
Yeah, I think within equities, when we look at it, we think that growth is continuing to be positive. We think that you do have those fiscal impulses relative to the One Big Beautiful Bill Act that might be coming online for the consumer and corporations in 2026, but also monetary policy, which we've had multiple easing from the Federal Reserve over the last 12 months, and even more so over the last 18 months. We know that typically takes around 18 months for all those policy actions to fully go into the broader economy, which that should support risk assets. So these fiscal and monetary impulses are beneficiary to risk assets like equities, but also that AI CapEx cycle will also be beneficial for overall just spending levels in its own right. And I think one of the things that's interesting is that in sort of the first 7 months of 2025, we saw investors completely rotate out of small cap equities. They had 20 billion of outflows in small cap equity ETFs. However, following the One Big Beautiful Bill Act, but also the intention of the Fed to ease monetary policy, you started to see investors come back into small caps. And they had inflows over the last months in 2025, about 13 billion or so. So even though small cap ETFs ended the year with net outflows for the year, there's this resurgence of buying back into small caps that took place in the near end of 2025. And that coincided with small cap equities outperforming large cap equities by about 13% since the end of July. And in the same token, this isn't just a sort of performance catch up. We've started to see earnings revisions move to the upside as well within small cap equities, where you have double-digit earnings growth forecasted for full year 2026, and revisions are skewed to the upside. So we think in this sort of macroeconomic backdrop, while there is some near-term and maybe some more structural, just overall trade uncertainty and geopolitical uncertainty, the fundamental bias is positive for small caps. And they do have those twin forces of monetary and fiscal impulses coming online into 2026 that should support risk assets.
Matt, it seems like some of the stuff that you're talking about kind of echoes what Jerome had addressed in the bond market, that there is this expectation that we will continue to see economic growth, both here and in certain jurisdictions abroad, and this idea that maybe inflation is still at play as well. You mentioned the small cap story. That's one that's more kind of levered toward the economic cyclicality story, right? That if the economy is growing, that these smaller cap companies will participate. Are there other places within the markets that you are seeing right now, Matt, that maybe echo some of that sentiment or are evidence that we could be seeing kind of like this growth, reflation-ish type trade or inflation type trade as well? Matt?
Yeah, so when we're looking at the fund flow patterns that we have seen. Oh, do you have me back now?
I think we just lost you for a second, but yeah, did you get the question? Are you?
Yeah, around inflation and those inflation dynamics, what we do see playing out from investor positioning is you do see an upward bias relative to inflation-linked bonds. So sort of try to infuse some of that inflation bias into the overall bond portfolio, into commodity complex as well. Broad commodities have done quite well. And from a flow perspective, they had their second most flows overall in 2025. From a sector perspective, we do see a bias towards cyclicals. So industrials are one of the areas of the marketplace that could potentially benefit from those same impulses we discussed around small caps, the growth formation, the capital expenditures, but also some of the provisions within the One Big Beautiful Bill Act around R&D expensing. But also within industrials, the aerospace and defense industry continues to sort of receive a bid higher as a result of new demand channels from this push towards self-sufficiency, not only from the US, but around the globe as a result of some of the measures we've seen play out over the last 12 months under the recent Trump administration as well. So irregardless of the 1.5 trillion spending that was forecasted by the Trump administration in the US, the demand channel for defense spending is likely to be evidence on a global scale. And that's why you see industrials doing well, aerospace and defense stocks, not only just in the US, but in Europe as well, performing quite admirably as we go into 2026.
Now, both of you have mentioned multiple asset classes with regard to some of your answers. You address things like bonds and stocks. You've even brought up maybe commodities and certain other assets out there as well. That to me screams kind of multi-asset, right? This multi-pronged approach, putting portfolios together that have allocations to all these different kinds of groups of things. Jerome, I know that PIMCO just in the last week, just last maybe Friday, I believe, has launched a new ETF product that has that kind of multi-asset approach. You mentioned before this pioneering of basically putting stocks together with bonds to seek out performance. What exactly can you tell us about this new ETF product that blends both of them together in this ETF wrapper? And what do you hope to gain from that multi-strategy, multi-asset approach?
Yeah, I think one of the key facets that we're trying to amplify for most ETF investors right now is that there's structural opportunities in fixed income, which can be repeated and create alpha generating returns on a routine basis. And when you put that together with the opportunity set for investors who just want to be married to an ETF or to a equity like index type of return, bringing them together creates a opportunity set that allows them to earn the equity beta, the equity returns in a static approach, and at the same time benefit from the excess return possibilities that are in actively managed fixed income strategies. PIMCO's been doing this for almost 40 years. We call it Stocks Plus. And so with the launch of PIMCO's new Stocks Plus active bond ETF, we're very excited that it comes to an ETF platform, which has a few different benefits than the traditional mutual fund approach. But more importantly, the approach now is that we're bringing active management in the bond space, which has routinely produced excess returns to those passive equity investors who may not necessarily realize that as a benefit. So over time, you'll hopefully benefit and outperform the S&P 500 in this new strategy as we bring that actively managed approach from our fixed income ETFs into the world of passive equity investing through our SPLS ETF.
Jerome, you're one of the portfolio managers of this SPLS ETF. What exactly are you hoping to gain in terms of that alpha or outperformance by marrying active fixed income strategies on top of a more passive S&P 500 strategy? What exactly can investors expect? I mean, we understand that, past performance is not indicative of future performance necessarily, but what exactly would you expect to see in terms of having this married approach with passive equities and active bonds in trading?
We are taking a long-standing proven approach that we adopted here at PIMCO in 1986 with our Stocks Plus business. What we're ultimately making available to clients is the ability to create repeatable avenues for alpha excess generation in the fixed income space, bringing that together with opportunity sets that are not necessarily as evident in actively managed equity landscape. So just to put context around it, historically, fixed income bond managers outperform their benchmarks by more than 90%. By contrast, only about 15% of active equity portfolio managers outperform their benchmarks. And so while you might have views like Matt does with regard to different sectors to rotate into, over the long term, it's clear that as an active fixed income manager, you can outperform indexes. And that's what we're putting together as the excess return generator combined with passive equity investing for that S&P 500. So if we look at the landscape today, sure, there's opportunities, there's concerns, there's high relative yields, high real yields as well. And those are opportunities that we see as repeatable ever since we launched our first ETF mint back in 2009 here at PIMCO. The theme at PIMCO's ETFs is actively managed ETFs that benefit from structural opportunities, but also take advantage of the different macroeconomic landscapes that we found ourselves in over the past 15 plus years. And so we're bringing that franchise together with the passive equity landscape and producing it for clients who might be interested in obtaining alpha potential in that fixed income landscape while maintaining their equity allocations within their broader portfolio.
Matt, is the multi-strategy approach something that you guys are seeing more interest in over at State Street? You see a lot of ETF products in your suite of offerings. You see a lot of maybe index-oriented ones. That's kind of what people have grown accustomed to with regard to State Street's ETF product suite. The multi-strategy approach, though, how much do investors, either the end clients themselves or the investment advisors who are kind of managing their money, how much do they actually have to start looking at this multi-strategy approach? And will that be a big theme for the rest of 2026?
I think it will be. I think one of the things that we've had multiple conversations with more recently is about this idea of balance and resiliency. And within our lineup, a lot of our conversations lend towards our multi-asset strategy with Bridgewater, with All W. And it's this idea of being balanced across different asset classes, being balanced from a geographical perspective across equities and bonds, but also different economic environments. And I think in this type of macroeconomic landscape where things are drastically changing every single day and every single headline, where the past 15 years are unlikely to be what we expect for the next 15 years, given this shift and this reworking of our macroeconomic paradigm, where there are likely to be more upside biasy risks towards inflation dynamics, given this sort of move towards self-sufficiency, which will likely increase deficits in fiscal spending. But also what we saw last year in 2025, 76% of non-US equities outperformed US equity, the US equity market. So 76% of non-US equity markets outperformed US equities. That's the largest hit rate since 2009. I think that's one data point to sort of illustrate that this is a different type of environment. The other one is how gold had its best return since 1979 on the back of many different macro forces, one being the sort of the debasement trade and the move towards alternative fiat currencies. Commodities, they've gone through a significant move upwards as well. So I think this idea of blending assets together to have resilience against a wide range of economic outcomes from all the geopolitical risks is something that I think investors should likely heed in 2026, because this is a new macroeconomic paradigm, and the idea of balance and resiliency can be put into play with something like a multi-asset strategy like we have with All W.
Matt, if I could just follow up with that, from a research strategist standpoint and point of view, is there a place within that multi-strat universe where you think that there is not as much of an investor exposure to that there needs to be? Is there, in other words, is there a catch-up? Is there an allocation adjustment that needs to be made in certain parts of the market that you feel are underexposed right now that need to be a little bit more brought up to I guess, a fair exposure for anybody's portfolio, time frames aside?
I would just say real assets. I think if you look at it across the dynamics of where assets sit today, even if we just look at the ETF market as a proxy, the majority of the assets sit in equities. And then, so I think it's roughly 80% is in equities, another 20%, or I say 15% in fixed income, another 5% is that sort of hodgepodge area. But largely what we see in client portfolios is they are structurally underweight real assets, whether that is inflation-linked bonds, gold, or commodities. And I think that is one area where a multi-asset strategy, you're not picking which asset class will be the best performing asset class. You're trying to own the risk premia out on offer across all different asset classes and try to move the needle towards areas that may be underrepresented in your portfolio, because we see so many portfolios that are US equity dominant or equity dominant. And I think this is one way to infuse balance in sort of a one-stop shop type of approach.
And Jerome, from your standpoint, from a portfolio manager standpoint that works in fixed income, where do you think your portfolios, your clients are maybe a little bit more underexposed to that you would look to kind of ramp up exposure in the coming months?
You know, people have gradually warmed to the idea of fixed income over the past few years, and it's taken some time, admittedly. You know, the zero bound or the zero rates that we saw for a long time, you know, sort of said, you know, left people asking the question, why fixed income? Now, when we see ourselves producing returns for the past several years of, you know, 6 to 8%, where income is part of one component, but capital appreciation and total return put you closer to those equity-like returns from a historical perspective, people are now looking to find better ways to diversify and, frankly, have a smoother ride. So we don't disagree necessarily with Matt's approach in terms of thinking about the opportunity set. We would instill in our clients that they need to be mindful of diversification. They need to be mindful that we're in the late cycle of a credit sensitive environment, but also we need to have ability to navigate and find opportunities given those degrees of freedom. And having an open mind, having degrees of freedom is part of that multifaceted approach that you'll find throughout PIMCO's active ETF strategies, no matter what the amount of interest rate exposure or where you want to find your opportunity set. So from that perspective, that's the compelling opportunity at this time is the ability to have the flexibility to navigate. And that gives you the opportunity to create repeatable structural opportunities to outperform baseline indexes, benchmarks, even money market rates. And from that point of time, that appreciation plus the income that's still relatively attractive, makes this outlook pretty compelling at this point for 2026 and potentially beyond.
And Jerome, a quick follow-up there. Do you believe that the parts of the market are out there for maybe that opportunity in, say, high yield? Is it corporate investment grade? Is it emerging market debt? Is it on the short part of the yield curve? Is it on the longer end of the yield curve? Then people want to take on duration. Where do you think that the opportunity really does lie in the coming months?
I'm not going to say all the above, so I will tell you a few things. First of all, first thing to rationalize is how you manage your cash. So taking a step out of the traditional cash markets is still worth 1 to 2% more by looking at an actively managed enhanced cash solution. Secondly, I think you have to look at is globally. As I mentioned previously, there's monetary policies which are moving in divergent directions around the world. The Central Bank of Canada is doing something different than the Bank of Japan. The Royal Bank of Australia is doing something than the Bank of England. We find ourselves in the relative value opportunity set as portfolio managers is exciting. Maybe not the average person watching this show has an appreciation for that excitement, but what we can do is find avenues to quantify those returns and those opportunity sets. So look at the world in a multifaceted relative value approach to drive returns. Third thing is not necessarily recognize that corporate credit is the only thing you can do in fixed income. There's other things. Securitized assets, agency mortgages are a great complement that are still attractive at these yield levels, at these spread levels. Whereas we are in a late cycle of corporate credit environment in that regard. And then finally, make sure that you're taking an active approach to that fixed income landscape. Passive benchmarks don't necessarily afford you not only to accentuate the opportunities that you see, but it also doesn't necessarily steer you away from the things that you don't want to own. And that's really the biggest risk as we get into this part of the cycle with uncertainty percolating, people's concerns about valuations, spreads, geopolitical risk, etc. But yet income remains a driving force here that remains pretty attractive for most people to consider as an alternative to the equity beta at this point in time. Putting them together is what we're bringing together in the new ETF SPLS here at PIMCO.
The coming months will be fascinating from a markets perspective for sure, and a price perspective as well. Jerome Schneider, Matt Bartolini, thank you both very much for being here on the show. Now, we've asked Matt to stick around for the ETF Edge podcast. You can catch that and all of our other content over at etfedge.cnbc.com. Thanks for watching. We'll see you next week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from top industry experts. Sign up now at cnbc.com/ETF Edge newsletter.